Ever wonder how a single tulip could cost as much as a mansion? The financial world operates on an illusion of control, where brilliant minds build castles of wealth. But sometimes those castles crumble overnight. From Dutch flower manias to billion-dollar Ponzi schemes, history's money blunders have rewritten the rules of capitalism. In this video, we'll uncover how spectacular financial disasters created the guardrails of modern investing. Because sometimes you need to lose $65 billion to learn a $65 billion lesson. 1. The Mona Lisa of speculative bubbles wasn't painted with oils, but with petals. In 1630s, Holland, tulip bulbs, yes, flowers, became worth more than houses. A single Semper Augustus bulb could fetch the equivalent of a mansion on Amsterdam's finest canal. Why? Mass hysteria disguised as investment acumen. The Dutch convinced themselves that pretty flowers were sound financial instruments. When reality finally bloomed in February 1637, prices wilted by 99% overnight. The collapse bankrupted countless Dutch citizens and forced the creation of the world's first futures market regulations. Next time you see a $5 bouquet at the grocery store, remember, those same flowers once crashed an entire economy. 2. In 1720, the South Sea Company pulled off history's most brazen corporate swindle by promising British investors exclusive trading rights with South America, a region firmly controlled by Spain, with whom Britain was actively at war. Did investors check this minor detail? Of course not. The company's stock soared 800% in 6 months. Parliament members bought shares while simultaneously drafting laws to benefit the company. When the bubble inevitably burst, careers and fortunes vanished overnight. The ensuing scandal led to the Bubble Act of 1720, which banned the creation of new joint stock companies without royal charter for over a century. Sir Isaac Newton lost $20,000, millions in today's money, and lamented, "I can calculate the motion of heavenly bodies, but not the madness of people." 3. You're standing on a Manhattan sidewalk in October 1929. The sky is literally raining brokers. Black Tuesday has arrived, and with it, the single worst stock market collapse in American history. The Dow plummets 12% in one day after years of mindless speculation. Ordinary Americans had been buying stocks on 90% margin, meaning they put down just $10 to control $100 worth of stocks. When prices fell, brokers issued margin calls that nobody could pay. The ensuing Great Depression would last a decade and transform American capitalism forever. The catastrophe birthed the SEC, Federal Deposit Insurance, and the separation of commercial and investment banking. All it took was the complete destruction of the global economy. Worth it? 4. Long-term capital management wasn't just a hedge fund. It was a pantheon of financial geniuses, including 2 Nobel Prize winners. Their complex mathematical models were infallible until they weren't. In 1998, with just $4.8 billion in equity, LTCM leveraged itself to control over $1 trillion in positions. When Russia unexpectedly defaulted on its debt, LTCM's perfect models imploded. The potential collapse threatened the entire global financial system, forcing the Federal Reserve to orchestrate a $3.6 billion bailout. The fund that was too smart to fail ended up defining the very concept of systemic risk, proving that even genius-level quants can't model the chaos of real markets. Wall Street's sobering lesson: excessive leverage plus overconfidence equals financial suicide. 5. Imagine creating imaginary companies, inside fake partnerships, tracked by non-existent accounting, all to hide billions in debt. Welcome to Enron, where executives transformed energy trading into financial alchemy. By 2001, the company that Fortune magazine named America's Most Innovative 6 years running was actually a hollowed-out shell game. The $63.4 billion bankruptcy wiped out 20,000 jobs and evaporated employee retirement funds overnight. It also took down Arthur Andersen, one of the world's big five accounting firms. The Enron debacle triggered the Sarbanes-Oxley Act, fundamentally reshaping corporate governance and creating personal criminal liability for executives who sign off on fraudulent financial statements. Sometimes it takes a Texas-sized fraud to inspire actual accountability. 6. Bernie Madoff pulled off a $65 billion magic trick by making investors believe he could generate 10 to 12% returns every year without fail, in bull markets, bear markets, any markets. His secret strategy? There wasn't one. For decades, Madoff simply paid older investors with newer investors' money while fabricating account statements. When the 2008 financial crisis triggered mass withdrawals, the scheme collapsed like a house of cards. The resulting 150-year prison sentence wasn't just punishment for Madoff. It was a wake-up call for regulators who had ignored whistleblower Harry Markopoulos's warnings for nearly a decade. The scandal forced a complete overhaul of the SEC's enforcement division and spawned numerous reforms to protect investors from the next too-good-to-be-true investment opportunity. 7. The dot-com bubble wasn't just irrational, it was mathematically impossible. By 1999, companies with no revenue were worth billions simply by adding .com to their names. Pets.com spent millions on Super Bowl ads, raised $82.5 million in an IPO, then collapsed 9 months later. The NASDAQ soared to 5,048 in March 2000 before crashing 78% over the next 2 years, vaporizing $5 trillion in market value. Companies with nothing but a business plan and a foosball table attracted venture capital like moths to a flame. The crash taught investors that fundamental metrics like revenue and profits actually matter, at least until the next tech bubble. The wreckage did leave behind some legitimate survivors like Amazon, proving that sometimes the emperor actually is wearing clothes. 8. In 2008, Lehman Brothers transformed from Wall Street titan to financial cadaver in a single weekend. After 158 years of weathering every financial storm, the bank finally drowned in a sea of toxic mortgage securities. Its $619 billion bankruptcy remains the largest in American history. The collapse sent global markets into freefall and turned subprime into a household word. Treasury Secretary Hank Paulson's decision not to bail out Lehman while rescuing other institutions remains controversial. The bank's demise led directly to the $700 billion TARP program and fundamentally changed how governments respond to financial crises. Lehman's tombstone might as well read, "Here lies the myth that big banks can safely regulate themselves." Wall Street would never be the same, at least until everyone forgot about it a decade later. 9. One rogue trader, one historic bank, one spectacular implosion. In 1995, 28-year-old Nick Leeson single-handedly destroyed Barings Bank, a 233-year-old institution that had financed the Napoleonic Wars and counted Queen Elizabeth II among its clients. From a back office in Singapore, Leeson made unauthorized derivatives bets that spiraled into $827 million in losses. When his scheme unraveled, the bank collapsed over a single weekend and was sold to ING for exactly $1. Leeson fled to Malaysia, ordered a last meal of steak and champagne, and scribbled "I'm sorry" on a note before his arrest. His spectacular fraud led to wholesale reforms in bank risk management and the separation of trading and back office functions. Sometimes the most expensive education comes from your worst employee. 10. On Black Monday, October 19, 1987, the Dow Jones plunged 22.6% in a single day, the largest percentage drop in history. There was no internet bubble, no housing crisis, no pandemic, just pure, unadulterated panic. The culprit? A perfect storm of international tensions, overvaluation, and a new financial invention called portfolio insurance that was supposed to protect against exactly this kind of crash. Instead, it accelerated the collapse through automated selling. The Federal Reserve responded by slashing interest rates and developing the Greenspan put, the implicit promise that the Fed would rescue markets in times of distress. This well-intentioned response may have sowed the seeds for every financial bubble that followed. Sometimes the cure becomes the disease. 11. Warren Buffett, the Oracle of Omaha, world's greatest investor, made what he calls his worst investment ever in 1993, buying Dexter Shoe Company. Buffett paid with 25,203 shares of Berkshire Hathaway stock, then worth $433 million. Those same shares today, worth over $14 billion. Dexter, meanwhile, completely collapsed in the face of foreign competition. Buffett later wrote to shareholders, "As a financial disaster, this transaction rivals the Louisiana Purchase." The lesson: even legends make catastrophic mistakes. Buffett's error wasn't just overpaying. It was using Berkshire stock as currency, effectively making the deal infinitely expensive as Berkshire's value grew while Dexter's vanished. Sometimes the world's smartest investor proves most valuable by showing us what not to do. 12. In January 2000, internet upstart AOL used its massively inflated dot-com era stock to acquire media titan Time Warner for $182 billion, the largest merger in American history. Just 2 years later, the combined company reported a staggering $99 billion loss. What happened? AOL's dial-up business was already being made obsolete by broadband, while Time Warner's old media executives never integrated with AOL's digital cowboys. By 2009, Time Warner spun off AOL at a valuation 99% lower than its merger price. The deal is universally regarded as the worst corporate marriage in history. It taught Wall Street that cultural integration matters at least as much as financial synergies, and that using bubble-inflated stock as acquisition currency is corporate suicide. Sometimes 2 plus 2 equals negative 100 billion. 13. Sir Alan Stanford wasn't just a financier, he was an international cricket sponsor, Texas socialite, and Knight of Antigua. His Stanford International Bank promised certificates of deposit with suspiciously consistent above-market returns. For years, regulators ignored whispers that Stanford's $7 billion empire might be hollow, until 2009, when the SEC finally discovered he'd been running a massive Ponzi scheme. His Antiguan auditor operated from a tiny strip mall and had never actually verified any assets. Stanford received a 110-year prison sentence, though his victims recovered just pennies on the dollar. The scandal forced the SEC to revamp its entire approach to international financial fraud and prompted new cross-border enforcement agreements. Sometimes it takes a Texas-sized fraud to expose regulatory blind spots spanning multiple continents. 14. Raj Rajaratnam, founder of the Galleon Group hedge fund, assembled the largest insider trading ring since the 1980s. His edge? An extensive network of corporate insiders who fed him market-moving information in exchange for cash. For years, Rajaratnam boasted about his research edge while managing $7 billion in assets, until a former employee turned government witness wore a wire. In 2011, Rajaratnam received an 11-year prison sentence. His sprawling case ensnared executives from IBM, Intel, and McKinsey, and marked the first major use of wiretaps in financial crime prosecutions. The investigation revolutionized how authorities pursue white-collar criminals, showing that Wall Street titans aren't too big to jail. Sometimes catching one very big fish requires entirely new fishing techniques. 15. Washington Mutual wasn't just big. It was the largest savings and loan association in America, with over $300 billion in assets and 2,200 branches. It was also aggressively stupid, originating ever riskier mortgages, while its CEO, Kerry Killinger, proclaimed, "We hope to do to this industry what Walmart did to theirs." On September 25, 2008, WAMU collapsed in a single day after a 10-day bank run drained $16.7 billion in deposits. The FDIC seized WAMU and sold it to JP Morgan Chase for a pittance, wiping out shareholders. The largest bank failure in American history helped establish the too big to fail doctrine. The government will now intervene before a major bank's collapse can trigger systemic contagion. Sometimes the best illustration of risk is a bank that thought the housing market could never fall. 16. Bear Stearns went from Wall Street powerhouse to financial footnote in just 4 days. In March 2008, the 85-year-old investment bank faced a liquidity crisis after its hedge funds made catastrophic bets on subprime mortgages. CEO Alan Schwartz appeared on CNBC to assure investors everything was fine, the corporate equivalent of, "These aren't the droids you're looking for." It didn't work. A classic bank run ensued, and Bear's stock plummeted from $157 to $2 in days. JP Morgan acquired the firm for $10 per share in a Federal Reserve brokered shotgun wedding. The collapse foreshadowed the financial crisis that would explode 6 months later and fundamentally changed how the Fed monitors investment bank risk. Sometimes the canary in the coal mine is actually a 383-pound bear. 17. The Bank of Credit and Commerce International wasn't just corrupt, it was corruption incarnate. Founded in 1972, BCCI operated in 78 countries with minimal oversight, becoming the preferred financial institution for dictators, arms dealers, terrorist organizations, and drug cartels. By 1991, investigators discovered the bank had created an elaborate corporate structure specifically designed to avoid regulation while concealing losses and fraudulent loans. The $20 billion collapse, then the largest bank fraud in history, forced regulators to create new international banking standards. A U.S. Senate report called BCCI, a corporate criminal enterprise that had systematically falsified its records. The scandal proved that financial institutions need coordinated global oversight. Sometimes it takes a truly international fraud to inspire truly international regulation. 18. The savings and loan crisis wasn't just a financial disaster. It was a mathematical certainty. In the 1980s, deregulation allowed S&Ls to make risky investments with federally insured deposits. The genius plan? Borrow short-term at low rates, lend long-term at high rates, and profit from the spread. When interest rates spiked, these institutions faced negative spreads, while their real estate investments collapsed. By 1995, more than 1,000 S&Ls had failed, costing taxpayers $124 billion. The debacle spawned the Resolution Trust Corporation to clean up the mess and fundamentally changed banking regulations. It also introduced moral hazard into the financial lexicon, the idea that government guarantees might encourage excessive risk-taking. Sometimes the road to financial hell is paved with deregulated intentions. 19. Michael Milken didn't just create the junk bond market. He was the junk bond market. From his X-shaped trading desk at Drexel Burnham Lambert, Milken transformed high-yield debt from financial pariah to Wall Street darling. His bonds financed corporate raiders and leveraged buyouts that reshaped American business. By 1989, Milken was earning $550 million annually, before the SEC charged him with securities fraud. His guilty plea and 10-year sentence, later reduced, coincided with Drexel's bankruptcy in February 1990. The junk bond market collapsed, taking the leveraged buyout boom with it. The scandal led to dramatic changes in securities regulations and corporate governance. Sometimes a financial innovation isn't a breakthrough. It's just fraud wearing a really expensive suit. 20. Penn Central wasn't just any railroad. It was the railroad, the result of merging the Pennsylvania and New York Central Railroads in 1968. 2 years later, it derailed spectacularly with the largest bankruptcy in American history. The company had $7 billion in assets, 100,000 employees, and operated a rail network spanning 20,000 miles. What went wrong? Everything. Incompatible computer systems, labor disputes, deferred maintenance, and management infighting created the perfect corporate train wreck. The collapse forced the U.S. government to create Conrail and rewrite bankruptcy laws. It also led to new financial disclosure requirements for publicly traded companies. Sometimes the biggest corporate failures teach the most important lessons about what happens when size outpaces competence. 21. Germany's 1931 banking crisis wasn't just economic, it was existential. The Weimar Republic, already weakened by hyperinflation and war reparations, watched in horror as its largest bank, Danut Bank, collapsed after making bad loans to a failing textile company. Panic spread, forcing the government to declare a bank holiday and nationalize major financial institutions. International creditors fled, unemployment soared to 30%, and political extremism found fertile ground. The crisis accelerated the rise of the Nazi Party and fundamentally altered European history. It demonstrated how banking panics can transcend economics to threaten democracy itself. The lessons? Central banks must act as lenders of last resort, and financial stability isn't just about balance sheets, it's about social stability. Sometimes a banking crisis can change world history. 22. In 1984, Continental Illinois was America's seventh largest bank with assets of $40 billion and a reputation for aggressive growth. Then rumors about bad loans triggered a massive run by institutional depositors. In 3 days, the bank lost $10 billion in funding, equivalent to 1/4 of its assets. When Continental collapsed, regulators created a $4.5 billion rescue package rather than risk systemic contagion. During congressional hearings, Comptroller of the Currency Todd Conover admitted that regulators wouldn't allow the 11 largest banks to fail, officially creating the too big to fail doctrine. This precedent fundamentally altered market discipline by implying government protection for large institutions. Sometimes a bank's greatest asset isn't on its balance sheet, but in Washington's fear of what might happen if it fails. 23. Orange County, California. Wealthy, conservative, and catastrophically overleveraged. In 1994, County Treasurer Robert Citron, who had no financial training but plenty of confidence, invested $13 billion in volatile derivatives while borrowing heavily through reverse repurchase agreements. His strategy: bet everything on interest rates staying low. When the Fed raised rates, the county's portfolio imploded, losing $1.64 billion. The resulting bankruptcy affected 1.6 million residents and 180 municipal agencies. Schools delayed construction, police departments cut services, and the county eliminated 3,000 jobs. The debacle led to new regulations requiring public disclosure of government investment strategies and restrictions on leverage. Sometimes the most dangerous investor isn't a Wall Street shark, but an elected official who thinks he's smarter than the market. 24. Russia's 1998 default wasn't just a national crisis, it was financial contagion perfected. After the Soviet collapse, Russia accumulated massive debt while attempting market reforms. By August 1998, oil prices plummeted, tax collection failed, and the government faced impossible interest payments. The solution? Simply stop paying. Russia devalued the ruble by 66% and defaulted on $40 billion in debt, sending shockwaves through global markets. The crisis destroyed Russia's middle class overnight and toppled long-term capital management in the United States. It proved that in an interconnected world, financial viruses spread across borders faster than regulators can erect quarantines. The lessons reshaped central bank policies worldwide and created new IMF intervention protocols. Sometimes when a former superpower catches financial pneumonia, hedge funds on the other side of the world start coughing up blood. 25. The Asian financial crisis began with Thailand's seemingly technical decision to float its currency in July 1997. The baht immediately plunged 20%, triggering a regional panic that engulfed Indonesia, South Korea, Malaysia, and the Philippines. Currencies collapsed, stock markets crashed, and governments toppled. Countries that had been Asian tigers suddenly became IMF patients. What happened? Excessive foreign borrowing, fixed exchange rates, crony capitalism, and real estate bubbles created perfect conditions for speculative attacks. When confidence evaporated, so did trillion-dollar economies. The crisis fundamentally altered Asian economic policy, leading to massive foreign reserve accumulation as self-insurance against future crises. Sometimes the most important financial lesson is simply, don't borrow in a currency you can't print. 26. WorldCom didn't just commit accounting fraud, it elevated cooking the books to an art form. Under CEO Bernie Ebbers, the telecom giant masked slowing growth by classifying ordinary expenses as capital investments, effectively spreading costs over years instead of reporting them immediately. By 2002, the company had improperly capitalized $11 billion in expenses. When the scheme collapsed, WorldCom filed bankruptcy with $107 billion in assets, dwarfing Enron's failure. The fraud destroyed $180 billion in shareholder value and 60,000 jobs. Ebbers received a 25-year prison sentence, and the scandal accelerated passage of the Sarbanes-Oxley Act, fundamentally changing corporate governance. Sometimes the difference between a blue-chip stock and a federal prison jumpsuit is just a few accounting entries. 27. Tyco International CEO Dennis Kozlowski didn't just steal from his company, he flaunted the proceeds. His $6,000 shower curtain, $15,000 umbrella stand, and $2 million birthday party for his wife, featuring an ice sculpture of Michelangelo's David urinating vodka, became symbols of corporate excess. Between 1995 and 2002, Kozlowski and CFO Mark Swartz looted $600 million through unauthorized bonuses, fraudulent stock sales, and personal loans disguised as business expenses. Their 2005 convictions on grand larceny charges resulted in 8 to 25-year sentences. The scandal led to new SEC disclosure rules for executive compensation and fundamentally changed board oversight practices. Sometimes a CEO's most valuable contribution to corporate governance is serving as a cautionary tale about what happens when no one says no. 28. The Regas family turned Adelphia Communications from a $300 small-town cable provider into the 6th largest cable company in America. Then they treated it as their personal piggy bank. By 2002, the family had borrowed $3.1 billion from the company without board approval, built a private golf course with corporate funds, and hidden $2.3 billion in debt in off-balance sheet entities. When the scheme collapsed, Adelphia filed bankruptcy, and founder John Regas, 77, received a 15-year prison sentence. The scandal led to dramatic changes in corporate loan disclosure requirements and board independence standards. It proved that family-controlled public companies need particular scrutiny since blood ties can undermine normal governance safeguards. Sometimes the most dangerous corporate structure is the one where dad says it's okay replaces proper financial controls. 29. HealthSouth CEO Richard Scrushy created a corporate culture where fraud wasn't just acceptable, it was expected. Between 1996 and 2003, the healthcare giant systematically falsified financial statements, inflating earnings by $2.7 billion to meet Wall Street expectations. Executives called these adjustments filling the hole and held family meetings to coordinate the fraud. When the scheme collapsed, 15 HealthSouth executives pled guilty, but remarkably, Scrushy himself was acquitted of all financial charges. Justice eventually caught up. He later received a 7-year sentence for bribing Alabama's governor. The scandal forced reforms in healthcare accounting and strengthened whistleblower protections. It also demonstrated the dangerous power of charismatic founders who create cult-like corporate cultures. Sometimes, the most effective fraud prevention system is simply a CEO who doesn't demand fabricated numbers. 30. Parmalat wasn't just Italy's largest dairy company. It was Europe's Enron, a multinational corporation built on fraudulent accounting. Founder Callisto Tanzi claimed the company had $4 billion in a Bank of America account in the Cayman Islands. The minor problem? the account didn't exist. By 2003, investigators discovered Parmalat had fabricated assets, used double billing, created fake companies, and forged documents for over a decade. The $14 billion collapse, Europe's largest corporate bankruptcy, led to 8 criminal convictions and fundamentally changed European corporate governance. Italy enacted its version of Sarbanes-Oxley, while the EU strengthened cross-border financial oversight. The scandal proved that accounting fraud transcends cultures and borders. Sometimes detecting corporate rot requires checking whether the milk money actually exists. This hybrid of comedy and commentary reminds us that financial fraud has a universal language. 31. Went from triumphant IPO to bankrupt shell in exactly 67 days. In August 2005, the commodities broker raised $583 million in its public offering. By October, the company admitted CEO Philip Bennett had hidden $430 million in bad debts through a Byzantine scheme of related party transactions. Bennett was so brazen, he tried to save the company by repaying the $430 million, without explaining where he suddenly got that sum. Refco filed for bankruptcy, customers lost billions, and Bennett received a 16-year prison sentence. The scandal forced a complete overhaul of IPO due diligence standards and dramatically strengthened disclosure requirements for related party transactions. It proved that even sophisticated investors and regulators can miss massive fraud hidden in plain sight. Sometimes the most important questions are the ones nobody thinks to ask. 32. Amaranth Advisors wasn't just a hedge fund. It was a cautionary tale about concentrated risk. In September 2006, the $9.2 billion fund lost $6.6 billion in a single week, the largest hedge fund collapse in history at that time. The culprit? Energy trader Brian Hunter's massive natural gas futures bets. When prices moved against him, the positions were too large to unwind without causing further market declines. The implosion represented 8% of the entire natural gas market and led to significant regulatory reforms, including position limits for energy traders. It demonstrated how a single trader at a private fund could threaten broader market stability. The lesson? Even sophisticated institutional investors need concentration limits and risk controls. Sometimes the most dangerous financial weapon is a trader who thinks he's smarter than the entire market. 33. Jérôme Kerviel didn't just break trading rules at Société Générale, he atomized them. The junior trader created $50 billion in unauthorized positions, more than the bank's entire market value, by exploiting his knowledge of back-office systems gained from his previous role. When discovered in 2008, his trades resulted in $4.9 billion in losses. Kerviel's defense: everyone knew what he was doing when his trades were profitable. The scandal forced banks worldwide to implement stricter separation between trading and operations functions. Kerviel received a 3-year prison sentence, but the true punishment was becoming a cultural symbol of financial recklessness. His name literally entered the French language as a verb. To Kerviel means to take an insane risk with someone else's money. Sometimes the most expensive education a bank can receive comes from its own employees. 34. AIG wasn't just another financial institution. It was the invisible thread connecting the entire global financial system. By 2008, its financial products division had written $500 billion in credit default swaps, essentially insurance policies on mortgage securities and corporate debt. The tiny 377-person unit generated enormous profits during boom times. The problem? AIG had no reserves to pay claims when markets crashed. When mortgage securities imploded, AIG faced immediate collateral calls it couldn't meet. The potential collapse threatened to take down Goldman Sachs, Morgan Stanley, Bank of America, and dozens of European banks. The solution? A $182 billion government bailout that effectively nationalized the world's largest insurance company. The episode revealed dangerous interconnections in the global financial system and led to dramatic reforms in derivatives regulation. Sometimes the most important part of the financial system is the one nobody notices until it fails. 35. Iceland's banking system didn't just fail in 2008. It fundamentally broke mathematics. The tiny island nation of 320,000 people somehow developed banks with assets 11 times its GDP. Kaupthing, Landsbanki, and Glitnir expanded aggressively by offering high-interest online accounts across Europe while making questionable loans to related parties. When credit markets froze, Iceland faced an impossible choice: let its banks fail or bankrupt the entire country trying to save them. Iceland chose the former, protected domestic deposits, but stiffed foreign creditors, and imposed capital controls that lasted nearly a decade. The krona collapsed 80% against the euro. The crisis forced a complete redesign of cross-border banking regulation and deposit insurance within Europe. Sometimes the most dangerous financial model is banking system larger than country. 36. Greece didn't just have an accounting problem, it had a national identity crisis. After joining the Eurozone in 2001, the country enjoyed German interest rates without German fiscal discipline. By 2009, Greece admitted its budget deficit was actually 12.7% of GDP, more than 4 times the EU limit. How did no one notice? Creative accounting, off-balance sheet transactions, and outright fraud, all facilitated by global investment banks eager for fees. The resulting debt crisis required $289 billion in bailouts, subjected Greece to humiliating austerity measures, and threatened the euro's very existence. Unemployment reached 27%, while GDP contracted by 25%, a depression worse than America's in the 1930s. The crisis fundamentally transformed EU economic governance and revealed the fatal flaws in the euro's design. Sometimes a currency union without fiscal union is just delayed financial disaster. 37. MF Global transformed from storied commodities broker to financial disaster in the space of 2 weeks. CEO John Corzine, former Goldman Sachs chairman, U.S. senator, and New Jersey governor, bet everything on European sovereign debt, leveraging the firm 40-1. When those bets soured in October 2011, counterparties demanded more collateral. The firm responded by borrowing from segregated customer accounts, a cardinal sin in brokerage. By the time the dust settled, $1.6 billion in customer funds had vanished. The scandal led to complete overhaul of commodity broker regulations and new protections for customer accounts. Corzine paid $5 million to settle civil charges, but faced no criminal prosecution, reinforcing the perception of a two-tiered justice system. Sometimes the most dangerous person in finance is a former master of the universe with something to prove. 38. JP Morgan Chase's London Whale. Trades weren't just big, they were ocean distorting. In 2012, Bruno Ixel, a trader in the bank's chief investment office, accumulated such massive positions in credit default swaps that he moved entire markets. CEO Jamie Dimon initially dismissed concerns as a tempest in a teapot before the trades lost $6.2 billion. The scandal revealed that even supposedly conservative banks had developed proprietary trading operations disguised as hedging, and that risk management systems could be gamed by determined insiders. It provided crucial momentum for implementing the Volcker Rule, prohibiting banks from proprietary trading with federally insured deposits. The bank paid over $1 billion in fines, and Dimon had his compensation cut in half. Sometimes, what banks call sophisticated risk management is actually gambling with someone else's money. 39. Archegos Capital wasn't just a family office, it was a financial bomb waiting to detonate. Founder Bill Huang, previously banned from Hong Kong markets for insider trading, used total return swaps to build massive hidden positions in a handful of stocks. By dealing with multiple prime brokers who couldn't see his aggregate exposure, Huang controlled tens of billions in positions, despite having only $10 billion in assets. When Viacom CBS stock dropped in March 2021, Margin calls triggered a cascade of forced liquidations. The collapse cost banks over $10 billion, with Credit Suisse alone losing $5.5 billion. The scandal forced regulators to reconsider family office exemptions from disclosure requirements and led to fundamental changes in prime brokerage risk management. Sometimes the most dangerous counterparty isn't the one with the worst credit rating, it's the one with the most secrets. 40. FTX wasn't just a cryptocurrency exchange, it was a particularly elaborate shell game. Founder Sam Bankman-Fried cultivated an image as crypto's responsible adult, the billionaire who slept on a beanbag chair and promised to give his fortune to charity. Behind the scenes, he was funneling customer deposits to his hedge fund Alameda Research, which lost billions on high-risk trades and venture investments. When the scheme unraveled in November 2022, $8 billion in customer funds had vanished. SBF received a 25-year prison sentence, while regulators used the collapse to justify tighter cryptocurrency oversight. The scandal proved that even in the supposedly decentralized crypto world, age-old financial frauds still work perfectly well. Sometimes the most effective disguise for financial misconduct is an altruistic persona and good PR. 41. Credit Suisse's 2023 collapse wasn't just a bank failure. It was a 167 years of Swiss banking tradition vaporizing over a weekend. After surviving world wars, depressions, and financial crises, the bank finally succumbed to a toxic combination of risk management failures, including the Archegos Capital and Greensill Capital debacles that cost billions. When depositors began fleeing in March 2023, the Swiss government engineered a shotgun marriage with rival UBS for just 3 billion Swiss francs, a 99% discount from Credit Suisse's peak value. The failure of a globally significant bank fundamentally changed how regulators approach systemic risk and forced a re-examination of too big to fail policies worldwide. Sometimes the most dangerous risk isn't on the balance sheet, but in a corporate culture that consistently prioritizes short-term profits over long-term survival. 42. Terra Luna didn't just crash, it performed a financially impossible triple backflip into the void. The cryptocurrency project promised a breakthrough, a stablecoin called UST that maintained its dollar peg through pure math rather than actual dollars. The system worked through an algorithmic relationship with Luna tokens until it catastrophically didn't. In May 2022, UST lost its peg, triggering an automated death spiral that erased $60 billion in value over 48 hours. Some investors lost life savings in what amounted to a spectacular real-time demonstration of why financial innovations need stress testing. The collapse accelerated regulatory scrutiny of stablecoins globally and forced a fundamental rethinking of cryptocurrency risk. Sometimes the most dangerous 4 words in finance are, "This time it's different." 43. Celsius Network marketed itself as better than a bank, offering crypto holders up to 18% yields with supposedly minimal risk. In reality, it operated like a digital Ponzi scheme, using new customer deposits to pay existing customers while making increasingly risky bets with user funds. When cryptocurrency prices crashed in 2022, CEO Alex Mashinsky continued claiming everything was fine, right up until the company froze all withdrawals in June. By July, Celsius had filed bankruptcy with a $1.19 billion hole in its balance sheet, leaving 1.7 million customers as unsecured creditors. Mashinsky now faces fraud charges, carrying decades in prison. The collapse highlighted the dangers of unregulated crypto lending platforms and accelerated calls for comprehensive digital asset regulation. Sometimes, the oldest financial scams find their most effective form in cutting-edge technology. 44. 3 Arrows. Capital wasn't just a crypto hedge fund. It was the nexus of an entire ecosystem's risk. Founded by Suju and Kyle Davies, the Singapore-based fund managed billions in assets and invested in countless blockchain projects. When Terra Luna collapsed in May 2022, 3 Arrows took catastrophic losses, but concealed them while continuing to borrow. the fund defaulted on more than $3.5 billion in loans, triggering cascading failures across the crypto industry. Jew and Davies fled to Dubai while liquidators hunted for missing assets. The implosion demonstrated how concentrated crypto risk had become among a handful of interconnected entities operating with minimal oversight. Regulators worldwide responded by dramatically increasing scrutiny of digital asset firms. Sometimes the most dangerous financial structure isn't a single institution, but a web of codependent entities, all capable of destroying each other. 45. Voyager Digital perfectly illustrates crypto's circular firing squad of 2022. The cryptocurrency broker offered customers FDIC-insured accounts with high yields, a claim that was both misleading and irrelevant when the company made a fatal $650 million loan to Three Arrows Capital, secured by nothing but trust. When Three Arrows defaulted, Voyager filed for bankruptcy, freezing customer accounts worth $1.3 billion. CEO Stephen Ehrlich cashed out $30 million in stock before the collapse, but faced no criminal charges. The debacle forced the FDIC to crack down on crypto firms misrepresenting deposit insurance and led to new disclosure requirements for digital asset platforms. It demonstrated how quickly contagion spreads in unregulated markets built on excessive leverage and insufficient collateral. Sometimes the clearest red flag is a financial firm promising both safety and above-market returns. 46. Silicon Valley Bank didn't just fail in March 2023. It executed the fastest bank collapse in American history. On Wednesday, it was fine. By Friday, it was gone. What happened? SVB made a catastrophic duration bet, investing billions in long-term government bonds that lost value when interest rates rose. Simultaneously, its tech-focused depositors burned through cash as venture funding dried up. When the bank announced a capital raise to cover bond losses, it triggered history's first Twitter-accelerated bank run. Within 24 hours, customers tried to withdraw $42 billion, a quarter of all deposits. The collapse forced regulators to guarantee all uninsured deposits to prevent contagion and sparked a fundamental reassessment of bank liquidity requirements. Sometimes the most sophisticated risk management systems are useless against the simple reality that no bank can survive if everyone wants their money simultaneously. 47. Signature Bank's 2023 demise wasn't just about banking fundamentals. It was about guilt by association. After Silicon Valley Bank's collapse, depositors and investors scrutinized other institutions with similar profiles. Signature had aggressively courted cryptocurrency customers who represented nearly a quarter of deposits. When these clients began withdrawing funds amid broader crypto market turmoil, the bank faced a classic run. Regulators closed Signature just days after SVB, citing systemic risk despite no evidence of insolvency. The $110 billion bank essentially failed because people thought it might fail. A self-fulfilling financial prophecy. The episode forced a regulatory rethinking of concentrated deposit bases and crypto exposure. Sometimes a bank's greatest vulnerability isn't its asset quality, but market perception of who its customers are. 48. First Republic Bank wasn't just another regional bank. It was a cautionary tale about catering to the wealthy. The bank specialized in jumbo mortgages for high net worth clients, who typically held deposits well above the FDIC's $250,000 insurance limit. When Silicon Valley Bank collapsed in March 2023, First Republic's sophisticated clientele did exactly what wealthy people do in a crisis: protected their money by moving it to too big to fail institutions. Despite a $30 billion deposit infusion from major banks, the hemorrhaging continued. Regulators seized First Republic on May 1, 2023, selling it to JP Morgan Chase. The $229 billion failure demonstrated that even relationship banking offers little protection when fear overtakes loyalty. Sometimes the most dangerous bank customers are the ones who understand banking too well. 49. Greensill Capital collapsed like a financial house of cards built atop quicksand. The supply chain finance firm, founded by Australian banker Lex Greensill, claimed to use sophisticated technology to provide early payment to suppliers. In reality, it was extending loans based on hypothetical, future receivables, money that might never materialize. Credit Suisse packaged these questionable assets into funds marketed to investors as low risk. When insurance covering these loans expired in March 2021, the scheme imploded. Credit Suisse froze $10 billion in funds, while Greensill filed for insolvency. The scandal engulfed former British Prime Minister David Cameron, who lobbied for Greensill while earning millions as an advisor. The collapse forced a fundamental reassessment of supply chain finance disclosure requirements and conflicts of interest. Sometimes, financial innovation is just lending dressed in fancy technological clothing. This analytical reflection with closing wit reminds us that human nature remains constant, even as financial instruments evolve. 50. Luckin Coffee seemed poised to become China's Starbucks after its 2019 NASDAQ debut. By January 2020, it claimed 4,500 stores and outpacing its American rival in China. There was just one tiny problem. Many of those sales never happened. An internal investigation revealed the company had fabricated 310 million Jiadan transactions, roughly 40% of its reported revenue. Luckin artificially inflated performance by creating fake wholesale orders and disguising marketing expenses. When the fraud was exposed, Luckin's stock collapsed 75% before being delisted. The company paid a $180 million SEC settlement, while its chairman was forced out. The scandal accelerated implementation of the Holding Foreign Companies Accountable Act, requiring foreign firms to submit to U.S. auditing standards or face delisting. Sometimes the most important due diligence question isn't how fast is it growing, but is any of this actually real? So that wraps up our journey through history's most catastrophic financial blunders. From Iceland's banking collapse to Luckin Coffee's $310 million fabricated sales, these disasters prove that even the mightiest financial institutions can fall when risk management fails. But what do you think? Are these spectacular failures proof that regulation is essential, or evidence that markets eventually correct themselves? Perhaps the FTX collapse or Silicon Valley Bank's downfall changed your perspective on crypto or traditional banking. Did we miss any financial catastrophes that shocked you even more? Drop your thoughts in the comments. The most insightful responses get pinned. If you appreciated this deep dive into financial lessons, prove it. Hit subscribe and ring that bell so you don't miss our next exploration of Wall Street's wildest moments.